Hi guys, welcome back to my channel. Kelvin here. When it comes to paying your house loan, there are two main camps. Team pay with cash and team pay with CPF. So which should you choose? Should you pay with cash so that your CPF can earn a steady from PP 2.5% interest? Or should you pay with CPF so that you can all in your cash into Tesla to get a higher return? Definitely not financial advice, yeah? So in this video, I want to discuss about the benefits of both camps, then share what's my personal preference, because you know, I'm something of a homeowner myself. But before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a chipmunk eating almonds. Okay, let's first start with the benefits of using cash to pay. First, you will avoid CPF accrued interest. Huh? What's that? Can eat one nah? If you check out CPF website, accrued interest is the interest amount that you would have earned if your CPF savings had not been withdrawn for housing. If you still cash no boss, what is that? Let me try to explain. Basically, if you use your money to pay for your house loan, you are borrowing money from the government. Borrowing money from yourself. If you had not touched your CPF money, you would have been in there happily earning a 2.5% interest. But now, since you use it to pay for your house loan, you will be earning less interest. Then, if you ever sell your house, you will need to pay back the missing 2.5% interest back into your CPF. So, that is accrued interest. But CPF is also my money, what? Why need to pay back? According to CPF, this is because your CPF money is meant for your retirement needs. So, if you ever use it to pay for your house, you will need to pay it back. For example, with a 400k loan, 30 years repayment period, and a 3% interest rate, the money payment is $1,686. Then, after 10 years, with a 2.5% OA interest, I will have accrued $27,226 interest in total. Which means that after selling my house, I will have to pay back this $27,000 interest back to my CPF. In most cases, this will be fine. But it's actually possible to end up with something called negative cash sale, where after selling your house, you have $0 profit in cash because you have to pay back accrued interest. Using the earlier example, maybe I sold my house for 420k, so I should have 20k profit in cash, right? Well, not quite, because after deducting that 27,000 accrued interest, I don't have any cash profit left. CPF found that in 2020, there's about 4,580 people who had negative cash sale, meaning even after selling for profit, they didn't earn any profit in cash. On the other hand, if you are using cash to pay for your house loan, you will avoid this whole issue completely. Second, by using cash to pay, your CPF will enjoy guaranteed returns. For now, CPF OA earns a good 2.5% to 3.5% interest. But wait, that's not all. If you are not using it for housing, you can transfer it to SA to earn a higher interest of 4 to 5%, totally risk-free. Meanwhile, your cash is sitting in the bank like a lazy bum bum, earning a set 0.5% interest. Or even worse, if you invest now, you can easily lose money in stocks or cryptos. Having CPF giving guaranteed returns is super helpful because it gives you a safety net. Like if you touch wood, lose all your money in stocks or cryptos, at the very least, you know that your CPF money is still there for you when you need it one day. You can just use it for retirement, or if one day you end up not having enough money to pay for your house loan, you can still use your CPF to pay. In a recent CPF report, they found that almost 40% of homeowners above 50 years old didn't have enough CPF savings to pay for at least 6 months of installment. In short, by not touching your CPF money, you will earn a guaranteed return, and you know that it's still there whenever you need it. Okay, there's one hidden benefit of paying with cash, and that is Card Up. Card Up lets you pay your housing loan with your credit card, and lets you earn tons of credit card rewards. As you might imagine, this is super good because your housing loan is actually quite huge. Take for example, if you are using UOB Premium Miles card to pay, you will earn 1.4 miles for every $1 worth of expenses. So let's say if your monthly installment is $1,600, after 19 months, you will earn enough points to exchange for a return business class flight to Bali. Yes, there's a 2.6% cutout fee in total. You will still have to pay $790 in fees. But it's still worth it because the flight ticket is $972. On top of that, you can also use a promo code to reduce the fee down to 1.85% for the first 6 months payments. So you end up saving even more money. Sign up link down below if you are interested. So that's the additional benefit of paying your house loan with cash. Can your CPF do that? Cannot, right? Quick pause, I want to talk about today's sponsor, Skillshare. Skillshare is an online learning community with thousands of online classes for all sorts of topics. They got tons of classes on video editing, photography, and graphic design. As you all know, I'm always looking for ways to improve myself. And right now, I'm taking a class called From Clueless to Content Creator, making engaging videos that attract an audience by Paylah, who's a professional filmmaker with years of experience. In this class, Aaron shares his tips on how to create engaging content, like what value you want to bring to the audience, how to effectively plan your shots, and how to better edit your videos and so on. So, because Skillshare is sponsoring this video, the first 1,000 people to use the link down below will get a 1-month free trial of Skillshare. In this 1 month, you can take dozens of these classes, from creativity to entrepreneur to improving your life. Sure, you will get to support this channel, but more importantly, you will get to learn tons of new stuff from Skillshare. With that being said, let's get back to the video. Moving on, let's talk about the benefits of using CPF to pay instead. First, cash has more flexibility than CPF. You can use your CPF OA to pay for house loan, education, investment, insurance. That's all. On top of that, you can't touch your CPF money all the way till 55 years old, when you become old apek and old ama. And even so, you still can't withdraw everything because you still need to keep a minimum amount in CPF called the full retirement sum. Right now, the full retirement sum is 192k, but it will just keep going up every year. On the other hand, you can use cash for basically everything, like buy Papa Cha, start a business, buy overpriced Starbucks coffee, or even achieve financial independence and retire early. Can your CPF do that? No, right? There's one more thing. CPF policies can change anytime. What if, touch wood, CPF be like, oh, sorry lor, you can only withdraw your CPF money at 65 years old. Or, oh lor, we are increasing the full retirement sum even more. Just some examples here. I'm not saying that this will happen. So in short, having cash on hand will give you more flexibility if you ever need the money. Second, even though you will have accrued interest when you use your CPF to pay, in most cases, this accrued interest doesn't matter because it's easy to forget one thing. Your CPF money is still your money. Eventually, you will still get back your CPF money, assuming you live till old age, yeah? And if you are not planning to sell your house, you won't even have to pay back the accrued interest. With that being said, there's a very specific scenario where accrued interest ends up being a downside. And that is if one day you suddenly need money for whatever reason, you decide to sell your house. But because of accrued interest, you can end up with little to no cash profit. So let's say you bought a 400k house. Then after 25 years, you decide to sell it at 600k. By right, you will expect to receive 200k profit in cash, right? No, CPF be like, hold up, you owe your CPF 195k accrued interest. But nah, here's a tiny 5k profit in cash. In this case, accrued interest can be a bad thing. But in most cases, it doesn't matter. Third, cash can give higher returns. How much can your CPF earn? Oh, only 5%. Oh, cash can earn a lot more than that. Okay, let's ignore Tesla, which gave some WTF returns in 2020. By just investing in a simple S&P 500 ETF, you will already earn a 12% 10 years annualized return. Or SWDA, which invests in the top companies around the world, you will still get a 9.6% 10 years annualized return. Or what about a super safe dividend stock like DBS, which gives 4.6% dividend, not including the capital gain in stock price. In short, even though CPF gives a steady PP interest, by investing your cash, you can easily get a much higher return over the long term. So those were the pros of using cash and CPF to pay for your house loan. As to how you should decide, it really depends on what you want. Do you need your cash for other stuff like investing or starting a business or early retirement? In that case, using CPF to pay would be a better option. But if you don't have much use for your cash, or if you are not planning to invest your money, then perhaps using cash to pay for your house loan would be a better idea, because at least your CPF money is still earning some interest. Okay, here's one trick that you should know. It's not just either CPF or cash. You can easily change this depending on your situation. Maybe in the beginning, you don't have much money yet. So what you can do is use CPF to pay first. Then in the future, once you have more money, you can do something called CPF housing refund, where you pay back the money to CPF. That way, you will have less accrued interest while enjoying CPF's 2.5% to 4% interest. As for me, I prefer to use CPF to pay instead of cash. That's because I want to invest my cash to get a potentially higher return, aka what big. And I'm also aiming for early retirement in my 40s. So I will need as much cash as possible. The accrued interest doesn't bother me too much because I'm not treating my house as investment. So I'm not expecting to receive any cash profit when I sell. But the downside of doing so is I will end up with lesser CPF money for retirement. Because of that, I will have to absolutely make sure that I earn enough money for retirement. Anyway, that's just my preference. But what about you? Are you using cash or CPF to pay for your house loan? Comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.